Salut! Aujourd'hui, nous allons parler d'argent. C'est important. I'm joking, guys. Thought I'd practice a bit of my French. Anyway, today, as always, we're talking about money, more money, and how to deal with money. I am still in Yeko Concours, and I teach the professionals or 9 to 5ers how to become the best of their money by giving you actionable financial tips on expense management and investment. Okay, so just saying that don't put all your eggs in one basket. Well, never has there been a time where it's much more important than in investing. And this is a common mistake that beginner investors make. You find one asset class, you throw in everything there, and you just hope stuff works out somehow. But when it comes to investment, risk management is so important. When we talk about risk management, we're talking about identifying the inherent risks in our investment options, classifying them, analyzing them, and most importantly, mitigating them. So, what do we do about these risks that we've identified? Do we accept them? Do we transfer them? Do we reduce them? Do we completely run away from them? And with each of these options, there are various things we can do about risk. For instance, we talk about transferring risk, we can, push it to an insurance company. And when it comes to personal finance and, investing, insuring, especially things like real estate and more tangible assets like your car and your house and your business, very important. When we talk about reducing risk, we can talk about diversifying. When we talk about abandoning risk, we talk about just don't put your money in there at all. And we're looking at avoiding it entirely. Avoiding entirely, don't put your money there at all. So all of these are options we can take. But today we'll talk about diversification in particular because most people just need to reduce risk. You know it's there. You can't entirely do something about it, but you can reduce its impact on you. And that's where diversification comes in. So when we talk about diversification, we are looking at, spread. And by spread, I mean investing in various, industries, in different companies, in different asset classes. You think about geography, the location of your investment and all of that. So with this video, right, and I'm going to just talk about a few strategies we can use in diversifying our portfolio. Okay, here's a story I get to hear from so many people that I have spoken to about money before. And sometimes some people invest in Forex. And Forex is very, very volatile, foreign exchange. And they think that by diversifying, when they put the money in different companies doing exactly the same Forex, they think they're diversifying. But the problem with that is that if there's a problem in that Forex space, it affects all the companies. So either way, even if you have 100,000 across 5 companies, your 500,000 is still on the same level of risk, regardless of who's running it. Now, let's say, for instance, at 500,000, you have 100,000 in Forex. You have another 100,000 in stocks. You have a different 100,000 in bonds, a different 100,000 in perhaps real estate or mutual funds. You're diversified. So if Forex market is impacted, perhaps the stock market won't be. And if the stock market is impacted negatively, then bonds will be, because traditionally stocks and bonds have a negative correlation. And by this I mean when the stock market is going up, bonds are very likely going down. And when bonds are going up, the stock market is very likely going down. So either way, your investment is protected on one side and then maybe at risk on the other side. I'm going to give you a pre-warning and say that there are layers to this thing and it goes deeper and deeper and deeper a lot more. But just to keep this video relatively short, and this will, fair warning, it's longer than most because it's really important before you start investing to know this. And if you're already investing and you're not practicing this, then now maybe it's time to, change things a little bit and just do things right. So let's talk about the industries. We have various industries where you can invest in. There are consumer goods, there's the energy sector, there's healthcare, there's real estate, there's technology, we have utility. So these are different sectors that you can invest in, especially if you're into the stock market. If you're investing in stocks, that's shares of various companies, you need to diversify your portfolio in the sense that you might have something in tech, and also have something, perhaps energy. Let me tell you why this is important, because if we remember in 2020, around the peak of the COVID period, so many people made good money. Let's go back a bit. In 2019, so many stocks, were down, especially tech stocks. We saw stocks like Microsoft, we saw Amazon, we saw Google. A lot of them, lost value share prices. Yeah, they did. And then towards 2020, they began to rebound. So if you invested in the stock market between 2019 and 2020, you sure must have made a lot of profits. But the thing there is that, though, although at the time when most of the stocks were going down, companies like Zoom Communications were soaring because people had shifted, to working from home. And, companies that were in health tech, fitness companies like Peloton, the stocks were soaring because people had to work, do their workout and exercises at home as opposed to going out and running on the road because nobody wants to fall sick. And then biotech stocks like Moderna, these are the guys giving us the vaccine today, Pfizer, Johnson and Johnson, they have a health biotech arm in healthcare, but they're also a consumer company. Stocks are soaring. Companies like Amazon also began to soar again because people couldn't go out, but they still needed food. They still needed, so retail businesses be beginning to soar again, Walmart and the likes. And so this is why it was also necessary to diversify your portfolio, because anything can happen in the market. Risk happens, and risk is an uncertainty. You don't know what's coming ahead, but you know it's going to come. So you need to spread. Okay, so we also can take a look at geographical location of the companies you're investing in. If you're in Nigeria, then you can invest in Nigeria, but you can also invest in the US and in the UK, and even in Asia. We have so many fintech applications these days. There's Bamboo, there's Trove, there's eToro. I think some people use Robinhood, people who are, in the US and other countries, a couple of other countries. You can use all these apps, and it gives you access to the stock markets from other regions outside of your own. So you can take advantage of this. If the stock market in Nigeria is, local, you can take advantage of the stock market in the US or somewhere in Europe, and just invest in things that will earn you money in foreign currency that hedges against the inflation risk on your naira. We also need to look at the asset classes. We have, based on your risk appetite, there are low risk, high risk, and medium risk assets. So you don't want to put all your money in high risk assets, because the thing with high risk assets is that while they have high returns, you also stand a very high chance of losing your principal. That's the capital you invested. So that's why you can invest in the stock market maybe 200,000, and then tomorrow your money is down to 180, and you're busy calling customer care and support and saying, "Why is my money reducing?" Well, it's reducing because you're investing in a high risk asset. While it has a high chance of giving you really big returns, what comes back, you might wake up one day and find that you have to earn 50,000, not 200. You also have that, face the risk of losing that money at the same time. So all of that works in place here. So what I'm trying to put out to us is that diversification is important. You cannot put all your eggs literally in one basket. You need to spread. You need to find, investment assets, asset classes that have maybe negative correlation with other ones, and you need to, spread money in them. It's always going to be a balance between getting high rewards and reducing your risk. So you have to find that sweet spot in the middle and what works for you, and you need to spread like that. I'm going to keep this short for now, but in subsequent videos, I'm going to go a little bit deeper on each of these things I've mentioned about spreading into industries, about the value and growth and value, large cap assets and low cap assets, into geography, into the different risk classes. But I hope that you really got something out of this. And if you have further questions, by next week, maybe sometime this week, I'll post a link where you can just reach out to me in one-on-one conversation for 30 minutes on Zoom, and we can dig a little bit deeper based on what is specific to you as an individual. So look out for the link on my one of my posts by Monday or by Tuesday, and I'll be sharing some of that. So thank you very much for listening to this. I hope you got value out of it. If you have any questions, I'm always available to answer them. Au revoir.